Steve here with IBC Global. In today's video, we are going to discuss how guaranteed interest rates impact whole life insurance policies. If you looked at two different whole life insurance products and you saw one with a 2% guaranteed rate and another with a 3% guaranteed rate, which one would you pick? Probably the 3% guaranteed rate. Should you pick that one though, if you're interested in a policy for cash value? Should you pick that one if you're trying to get the lowest possible premium for a certain amount of life insurance? The guaranteed rates will impact several factors in a life insurance policy. There are three main items we're going to talk about. So how guaranteed rates impact life insurance policies are as follows. It'll impact your cash value. We're going to look at the guaranteed cash value on three illustrations with three products that have three different guaranteed rates. It will impact the death benefit, specifically how much guaranteed death benefit a premium purchases you. You'll see the exact premiums for a $1 million death benefit in this example. And then here's a big one, which has to do with an IRS calculation. It will impact the MEC limit, which is our modified endowment contract limit. That's that taxable line. It's what the IRS uses to determine the maximum amount of money you can pay into a policy per year and still reap the tax-free benefit of the cash value, which we all want. Okay, so we're going to look at three products here that all have different guaranteed rates. We'll look at what is called an L121. 121 represents the age that premiums are contractually due for. So 121 means when you're 121 years old. I don't know anyone who's made it that long, but if you were to look at a life insurance illustration or contract, that's how long the premiums would be due for. You don't have to pay it that long. We're going to see paying into it for a short period of time too. But that's an L121. It'll have the highest guaranteed rate of 3.75%. Then we've got an L95. 95 represents the age I can pay into it, so until I'm 95 years old. And then a 10 pay, which means I can pay into it for a maximum of 10 years. What do you notice about the guaranteed rates? They're different. L121, 3.75, L95, 3%, 10 pay, 2%. If you have an insurance company, if you have a product with an insurance company that has a dividend rate of 6%, doesn't matter because the dividend rate will be the same. You just have a lower guarantee with some of the products. Does it matter? The answer is yes, it 100% matters, as the guaranteed rates will impact how much guaranteed death benefit the premium purchases you, and then two, it'll impact the non-guaranteed cash value, particularly the internal rate of return, call it the growth rate, when we look at how much that cash value grows by. Now, how guaranteed rates and dividends work is you always get just the dividend, as that dividend rate includes the guaranteed rate. Sometimes we get the question, do I get the guaranteed rate plus the dividend? No. If I get a 10-pay product and I have a dividend of 6%, that means my contractual guarantee is 2%, but the company had a good year, declared a surplus in earnings, and they're paying more than 2%. It's the total dividend rate. Last item to note on this piece, anytime you see a guaranteed rate or a dividend rate with a life insurance policy, know that it is always, always a gross rate, never a net rate. Meaning, if I see 6% on my life insurance policy, a 6% dividend rate, and I have $100,000 in cash value, what is 6% of 100K? $6,000. Will it grow by that much? It will not, because any type of interest rate with a life insurance policy, again, is a gross rate. It's applied to the policy after the company's cost of insurance and everything that comes with that life insurance policy. We will look at net returns in this video too, just to attempt to make that more transparent. So let's look at Joe. Joe is 35 years old. There are two approaches he is interested in. These are how most people approach life insurance. Approach A, he just wants a $1 million policy. He says, I want a $1 million death benefit. How much will it cost me? Specifically, how much is the premium for a $1 million policy with these three different products. I want to know how the guaranteed rate will impact the premium. Make sense? We'll look at that in a moment. Approach B, though, Joe says, I don't care about the death benefit. I'm doing this for the cash value. I want to fund $50,000 per year. What is the minimum death benefit I can get to prevent a modified endowment contract from occurring? Because what you'll find when you look at the MEC limit is that the death benefit and the guaranteed rate have a direct impact on that. So this will be an interesting approach because we're going to see him asking for the same illustration, the same company, show me putting the same dollar amount in, but different death benefits because of the different guaranteed rates. You'll see what I mean when we get to them. So let's begin with approach A. And what we're going to do here is look at the numbers side by side, and then we'll come back and write the premiums, list the premiums out. So we've got the illustrations here. So beginning with the Whole Life 121. See that up top? That's the name of the product. Down here, we've got the death benefit, $1 million. What he's doing here is just buying a $1 million whole life policy, and it costs him about $12,000 per year. Then we've got that Whole Life 95 product, same $1 million death benefit. It costs him $16,400 per year. And then we've got the 10-pay product, 10-pay whole life, same $1 million death benefit. It costs him $53,000 in change per year. So what do you notice? Let's go back to our board here. The L121 had the highest guarantee, and it also had the lowest premium of about $12,000 per year. The Whole Life 95 has a lower guaranteed rate. I can pay into it for a little bit shorter period of time until I'm 95. Not many people do that, but that's how long I can pay into it. And the premium was $16,400. And then we had the 10-pay product, the lowest guarantee, which does result in a higher premium for the same death benefit. And also, I can only pay into it for 10 years. So a big reason why that premium was higher with the 10-pay product is because the insurance company is saying to us, your premium is only due for 10 years. So if I, the insurance company, am going to give you the same amount of life insurance and you're going to use this 10-pay product, you're going to have to pay me a lot more in this shorter period of time in order for me to turn around and say, I will guarantee that your beneficiaries will get this when you die, no matter what. That's what's going on here with the guaranteed rates with respect to price quoting. So this guy was $53,000 and change. I'm just going to write 53. So to answer Joe's question, I want a $1 million whole life insurance policy. How much will it cost me? The higher the guaranteed rate is, the lower the premium. If I'm just buying a policy for death benefit and looking for the lowest possible premium, the higher the guaranteed rate, the lower the premium. Want to see a side-by-side comparison? I do. All right, let's take a look. We've got the Whole Life 121. There's your premium, $11,960. Then we've got the L95. Look at the guaranteed rate up here. It's 3% instead of 3.75. Premium over $16,000. And then lastly, we've got the 10-pay policy with the lowest guarantee. Now the values we're looking at here are the non-guaranteed values of a life insurance illustration. So we've got a side-by-side. Well, what do you notice? With the L121, you've got a higher guaranteed rate. Look at your first year cash value. 0 right out of the gates. The L95 is not that much better. But if we look at the second year, the L95 is a lot better. That's how that product also works. But then with the 10-pay product, that product with a lower guaranteed rate is designed more for cash accumulation, so we get a chunk of that premium show up in cash value. Again, These are the non-guaranteed values. We're about to get to the guaranteed values. But that does display a nice side-by-side, and if you're trying to see which one gives you the most value, I would encourage you to look at the total premiums as well, and then we can throw a return on it or something like that if you'd like. However, that's not how most people we work with get whole life insurance. Usually, they're taking what I like to call a good approach, approach B. So here Joe says, I'm not really interested in the life insurance up front. I want to pay in $50K per year. And what I'm interested in is the cash value. Show me the returns and how it works. Okay, so we're going to do exactly that. Let's start with this, the MEC limit over here. So he's asking for the minimum death benefit possible. Let's start with the whole life 121 product, and we want to look at the guaranteed rate of 3.75%. If Joe, at age 35, wants to put in $50,000 per year, we want to solve for the minimum death benefit needed to give him a $50K MEC limit. And with a 3.75% guaranteed rate, that's going to come out to a death benefit of just about $1.5 million. Let's look at the illustration. Here we go. So we've got this policy all jazzed up for cash value. Here's what I want to hit on. There's your death benefit of $1.5 million. What is he paying? I'll highlight this in yellow. $50K per year. There you go. Only for 5 years. And then he stops. Never pays another penny into it. Look at his cash value. This is the 121 product. Remember, this was a 0 in the price quoting option we looked at. Here's his premium, $4,500 and change. Here's his PUA rider, which is how we maximize the cash value. This is also optional. He's not required to throw this much in. We just blended it for maximum cash value to the penny, which is what we always do. So there you go, $50K per year going in. All right, that's the whole life 121 product. We solved for the minimum death benefit to give him a MEC limit of $50K. So how do we reverse engineer this for maximum cash value? Because that's what he wanted. And first, he wanted to look at the 121 product with a guaranteed rate of 3.75%. Next, he wanted to look at the whole life 95. So look up top here. We're still in the 121. See those columns I just highlighted? Watch this. Have they changed? They did by a penny, right? They didn't change. 1 penny doesn't count. There's the premium, there's the PUA, there's the out-of-pocket. There's the product. There's the first year cash value. Very similar. What's different? Look at this. $1.15 million instead of 1.5. It's a $450,000 reduction. I'm sorry, $350,000 reduction when we look at the death benefit there. So for the same $50,000 MEC limit, that whole life 95 product only requires $1.15 million in death benefit. What's the important item to be aware of here if I'm a consumer? I need less life insurance to pay the same dollar amount in. When I look at the non-guaranteed values, I'll see more value here, not necessarily on the guarantees. Main takeaway, if I'm looking at a lower guaranteed rate, I'm going to see a lower death benefit with the same dollar amount going in. So we kind of need to throw the approach away, or I would throw the approach away of I've got to look at an apples to apples comparison of the same death benefit. When I change the guaranteed rates, it's a different apples to apples comparison. The comparison is that MEC limit. So how it's impacting the death benefit and MEC limit is lower guaranteed rate means I need less death benefit for the same MEC limit. If I look at the 10-pay product, I'll just write this one out and then we'll look at the comparison, comes out to about $800,000. in total life insurance in order to attain that same $50,000 MEC limit. Let's look at a side-by-side. And what we'll start with are the guaranteed values. Now we're going to look at the growth rate or the interest rate here. We'll begin with the L121 product. Here, we have a $50,000 MEC limit. First question I have is, where's my money going? Premium, $5,000. This includes the base premium. We also have a term insurance rider attached. Then we've got our PUA rider. And then our net out of pocket is $50K per year. That's what Joe wanted to do. He wanted to get a total of $250 into the policy, let it ride, and then use it for opportunities. But he wanted to see what the difference is with the different guaranteed rates. So when we look at this, total out of pocket, cash value, this is the guarantees up here, just to make that point very, very clear. There's our death benefit. So what do you notice here? Break-even point is when? Year 8. Guaranteed rate is 3.75%. Does that mean you're going to grow, your money is going to grow by 3.75%? It does not. Look at this. Annual ROR. ROR means rate of return. This part is so important and where people get upset after they purchase whole life insurance. They think their money is guaranteed to grow by 3.75%. Not how it works. First, annual rate of return. I pay in 50, I have 42,000. I don't care how you spin that. That is a loss of 16%. I took a hit on my money of $8,000 here. Next year, I pay in 50. It grew from 42 to 85. If I have 42 grand under my mattress and I add 50 grand to my mattress, how much would my mattress now be worth? Had 42 plus 50, that'd be 92. Do I have $92,000 here? I do not. That's why we still have a negative return here. Why we still have a negative return year over year, because we have a guaranteed rate of 3.75%, is because the insurance company is overcharging us for the premium, particularly in the first 2 years. And I also have PUA fees, which are going to drag down the net return. So as I keep on making payments, eventually I get out of the red, then I stop, so I never pay another penny into it. And this is the net return on a yearly basis, the annual ROR, not the IRR. Your guaranteed rate was 3.75. Did it ever hit 3.75? No, it did not. So this is always beneficial to see. Now granted, this is also guaranteed, and if I look at a taxable equivalent, this will be attractive to some folks, especially if we go back down to a very low interest rate environment. That's where people would like this type of product, particularly those interested in just guaranteed cash value growth. But guaranteed rates based on the whole life 121. Next, what do we got? The L95 product. What do you notice here? 3% guaranteed rate. Look at this. Does it ever hit 3%? No. Is it better or worse than the example to the left? Look at year 20. Worse. The 121 has stronger guaranteed values because it has a higher guaranteed rate. That's the reason why. And then lastly, we've got the 10-pay product. What do we notice here? Lowest guaranteed rate. Does the guaranteed, or does the rate of return ever hit 2%, that guaranteed rate? No, it does not. Before we go into the non-guarantees, because that'll tell a different story, a couple things I want to highlight here. One, look at your death benefit from year 7 to 8 on all of the illustrations. It drops. The reason why is because we had a term rider attached. We chopped it off that year. Year 8 is the earliest we can reduce the death benefit without triggering a modified endowment contract, which is a taxable event. If I wanted to pay into it longer, I might have to keep that term rider for a longer period of time. What else do you notice? When you look at the guaranteed values, which is what we're looking at right here, after you drop the death benefit and stop paying into it, which option guarantees you the most death benefit? This guy. And the reason why is because of the higher guaranteed interest rate. If you're the insurance company, you sell me a whole life insurance policy. The higher the guaranteed rate is on the product you sell me, the higher the guaranteed death benefit is. So when you say, I'm going to give you a higher guaranteed interest rate, remember you're a life insurance company, what that means is you're guaranteeing more death benefit too. So the guaranteed rate has a very strong impact on the death benefit. Also, on the guaranteed cash value when we look at that. So let's wrap up by looking at these same illustrations, but based on the non-guaranteed values. And then I'll tell you what I would do here when I'm looking at a product. So what we've got first is the Whole Life 121 product. What do we see here? Guaranteed rate of 3.75%. There's the funding, $50K per year. Cash value looks a lot better here, doesn't it? Breaks even between years 5 and 6. What's in red there is that death benefit drop. But there's your annual rate of return. A little bit less than 5% per year when we look at this. Next, what do we have? The Whole Life 95 product. Lower death benefit, because I don't need as much here. Same MEC limit of 50K. Returns almost the same in the first year, because the policy design is still the same base premium. But what happens as time passes? Looks a bit stronger. What happens if we look at year 20? With the 121, you had 502. The 95, you've got 522. So we see more cash value here. Let's look at the 10 pay. What do you notice about this? Let's look at the same year 20 actually. You can see it in the returns already. You're at 530 here. So you see stronger cash value growth. If you look at the death benefits though, what do you notice by the 20th year? Well, that 121 is stronger. Now this guy's starting at age 35. If this was a 55-year-old, the story would be a little bit different by year 20. But if we scroll down here, we can just look at age 80. Something I like to say to folks when they're looking at a high cash value life insurance policy. Let's look at 85, because that's usually around the point in time when companies think we're going to kick the bucket. The product with the most cash value long-term. Long-term means when the insurance company thinks we're going to die. The product with the most cash value long-term will also have the most death benefit. So the 10 pay had the smallest death benefit when we started, but the most cash value has the most cash value long-term, also has the most death benefit long-term. So it's good to look at there, or good to be aware of, I should say. Again, all of these are same company, same product. This is with Guardian. Their 2024 dividend interest rate is 5.9%. I know we had 6% on the whiteboard earlier. That was just to make the example simple with a nice rounded number. So let's recap the 3 points. How guaranteed rates impact life insurance. When I look at the cash value, how that is impacted. The higher the guaranteed rate is, the higher the guaranteed cash value will be. But the higher the guaranteed rate is, the lower the non-guaranteed cash value is. Always good to be aware of that when I'm looking at an apples to apples comparison of the same company but products with different guaranteed rates, like we just did there. Next, death benefit. How guaranteed rates impact life insurance when it comes to the death benefit. The higher the guaranteed rate is, the more death benefit I will get for the same premium. So this is relevant if I'm price quoting. If I said I just want a $1 million death benefit and I want to pay the minimum amount possible for that, That's where going with a higher guaranteed rate will benefit me because I will see the lowest premium as a result. And then third, the MEC limit. How do guaranteed rates impact the MEC limit? This has to do with the death benefit, but with the MEC limit, the lower the guaranteed rate is, the less death benefit I'll need for the same MEC limit. Meaning I need less life insurance, which means less cost to pay the same dollar amount in. That is one reason why products with lower guaranteed rates produce higher non-guaranteed cash values. There's more to it with how the dividend calculation works and such. Also, if you were to look at life insurance companies like MassMutual, like Guardian, when they provide a description of their 10-pay product or products with lower guaranteed rates, they outright state these products are more geared toward individuals that are interested in life insurance for cash accumulation. So they're positioning the product in that manner as well. And to hit on which one I would do, like what I would do, personally, if I was new to this, I would want to see something similar to what we looked at. If I'm approaching it for cash value, I'd probably go with either the L95 or the 10-pay product if it's with one of the four major mutuals, like a Mass Guardian, New York Life, or Northwestern Mutual. And the simple reason why is because we've seen that consistent proof of performance, not just good-looking illustrations, and then it doesn't pan out over time, proof of performance on the non-guaranteed side of an illustration. And those two products give me strong cash value and death benefit. That L95 I like because it's also very flexible and provides a decent amount of upfront cash value without sacrificing too much long term. All right, I know that was a lot of information. I hope you enjoyed the material. If you have any questions at all, please feel free to leave them in the comments below. And as always, I hope this helps. Thanks so much.